When a doctor evaluates a patient, they don't just take their overall body temperature, shrug, and say, yep, 98.6, you are perfectly healthy, go home.
Right, they'd be a pretty terrible doctor if they did.
Exactly. I mean, they look at the specific vital signs, right? Blood pressure, oxygen levels, heart rate variability.
All the underlying metrics.
Yeah, and if we're tracking the stock market, well, taking the overall temperature of an index is easy. It's the headline number everyone sees on the news.
Right, but it doesn't tell the whole story.
Not at all. To understand the actual physiological health of the market, you have to get granular. You have to, look at the individual vital signs of specific stocks before making any kind of macro diagnosis.
And we're doing exactly that for today's deep dive. Welcome in, everyone.
We are looking at a really comprehensive technical market report for today, August 17th, 2026.
And while we do have the overarching data on the KSE-100 index, the real meat of our source material today relies on the 4-hour charts of a very specific set of high-drama individual scripts.
So our mission for you today is to basically cut through the raw data. We want to translate this massive stack of technicals into a clear, actionable map of market sentiment.
And we are operating strictly on the 4-hour time frame today.
Which is huge. For those of you trading actively, you already know the 4-hour chart is that crucial middle ground.
Right. It filters out the intraday algorithmic noise, but it's still sensitive enough to show us institutional order flow shifting in real time.
Yeah, well, before it ever registers on the daily or weekly charts.
Yeah.
So let's establish the macro environment first.
Because the context dictates how we interpret everything else.
Exactly. So as of today, the KSE-100 closed at 180,502.44.
Up just 397.83 points.
Yeah, which is a fractional 0.22% move.
Hmm.
The day's range saw a high of 181,158 and a low around 180,281. Volume hit over 511 million shares.
Which is a solid amount of volume.
It is, but here's the data point that really stands out to me. If we look at the trailing one-year performance, the index is up a very solid 23.22%.
A great year on paper.
On paper, yeah. But the year-to-date change, like the actual progress we've made since January 1st, is sitting at a highly uninspiring 3.70%.
It's been flat.
Super flat. The report calls this a consolidation phase. But, I mean, looking at those numbers, I'd argue we are looking at pure stagnation.
I can see why you'd say that.
Right. The market hasn't really gone anywhere for 8 months. I guess my question is, how is a 3.7% return over 2/3 of a year considered a healthy setup for a run at the 182,359 resistance level?
Okay, let's unpack this. You have to look at what that 511 million share volume represents during a flat year.
Okay.
When a market rallies 20% in the back half of the previous year, you're left with a massive amount of floating supply.
Meaning people who bought in early.
Exactly.
Yeah.
You have early buyers who are sitting on huge unrealized gains, just waiting for the right moment to hit the sell button.
So they're just hovering over the exit.
Right. So for the index to hold the 180,000 line for this long without a significant retracement, it means institutional buyers are actively absorbing all of that latent selling pressure.
Oh, wow. So it's a massive transfer of risk.
Yes. Consolidation is basically a runner catching their breath after a long sprint.
Ah, that 23% gain.
Exactly. They're catching their breath before trying to smash through that 182,000 resistance wall.
So they're essentially chewing through the order book, letting the weak hands exit without letting the price collapse.
It's pure supply absorption. If the market were truly weak, that overhang of supply would have dragged us back down to the 160,000 range months ago.
That makes a lot of sense. The fact that buyers are willing to step in and hold the line just below that 182,000 wall indicates a structural basis forming.
Exactly. It's a healthy digestion of those previous gains.
Okay, so the macro index is grinding through supply, holding steady, but when the overarching market is flat, the capital rotates.
It always does. Traders get bored.
Right, and that brings us to the extremes. While the KSE-100 is digesting, specific components are experiencing massive volatility. Let's look at Pakistan State Oil, PSO.
Okay, PSO.
We are currently priced at 382.0. We had a decisive breakout above its channel resistance. Immediate target is 390.20 with a secondary target at 408.72.
Those are strong targets.
They are, but the report flags a massive warning light. The stochastic RSI is sitting at 81.01.
Right, and this is where we need to differentiate between standard RSI and stochastic RSI.
I am so glad you brought that up because throwing the word stochastic in front of RSI often just, confuses the issue for a lot of people.
It sounds way more complicated than it is.
Yeah. I mean, standard RSI measures the velocity and magnitude of directional price movements. It tells us if a stock is overbought or oversold based on its own recent closing prices.
Right, standard RSI is a great baseline.
So what does the stochastic overlay actually do to the math?
Well, standard RSI can remain overbought or oversold for long periods during a strong trend.
Which makes it kind of a blunt instrument sometimes.
Exactly.
Yeah.
Stochastic RSI is essentially an indicator of an indicator.
Wait, an indicator of an indicator?
Yeah, it applies a stochastic oscillator formula not to the price itself, but to a set of standard RSI values over a specific period, usually 14 intervals.
Okay, so it calculates where the current RSI value sits relative to its highest high and lowest low over that look-back window.
You got it.
I have to push back on that methodology, though. If you're taking an indicator of an indicator, aren't you just double lagging the data?
That's a common misconception.
By the time the stochastic RSI tells you the momentum has peaked, hasn't the algorithmic selling already started?
It's actually the exact opposite. Because it's measuring the RSI relative to its own recent range, it is hypersensitive.
Oh, really?
Yeah, it moves from 0 to 100 much faster than standard RSI. So when you see PSO hit an 81.01 on the 4-hour chart, right as it breaks out of a channel.
It tells you that the momentum required to break that resistance was exhausting, meaning the buyers had to burn through so much capital just to clear the sell limit orders sitting at the channel boundary.
Right, they might not have the liquidity left to sustain the push to 390 right away.
It's like driving a car, right? You're making great time, that's the breakout, but the engine is completely redlining.
Yes, the 81 stochastic RSI is the tachometer flashing red.
So it might stall if you don't ease off the gas.
You're looking at a localized liquidity sweep. Often, price will break above a known resistance level just long enough to trigger the stop-loss orders of short sellers.
Which creates a temporary spike in buying pressure.
But once those stops are hunted, if the organic demand isn't there, which that 81 RSI suggests it isn't, the price tends to snap back into the channel.
Wow, okay. And we see a similar setup with TPL at 22.93, right?
We do.
The report places TPL in a profit-taking zone. It hasn't fully broken out like PSO, but it's rubbing against the upper boundary of its range with a stochastic RSI of 78.34.
It's definitely running hot.
Yeah, the data suggests a retracement back toward its 22.08 support, with resistance sitting at 24.57 and 26.61.
When you combine a price hitting a known resistance zone with a highly sensitive momentum indicator flashing near 80, the algorithmic trading models are programmed to initiate distribution.
They start selling off.
Right. They start scaling out of their positions, providing liquidity to the retail traders who are late to the party and just blindly buying the top of the range.
And that algorithmic selling naturally suppresses the price back toward the 22.08 support.
Exactly.
Okay, let's flip the axis entirely and look at the exact opposite scenario. We've established what momentum exhaustion looks like at the top. Let's look at it at the bottom.
The oversold extremes.
Yeah, we have Gandara, tire, and rubber, GTYR. Price is sitting in a buy zone at 33.70, and the RSI is sitting at 2.70.
It's incredible.
Not 27, 2.7.
It is a statistical anomaly to see an RSI that low on a 4-hour time frame.
I mean, I'm looking at this number and trying to imagine the order book. How do you even reach a 2.70?
It requires an absolute cascade of selling.
But doesn't the sheer volume of selling eventually dry up just by virtue of everyone having, already exited their positions?
Usually, yes. A reading of 2.70 usually implies forced liquidations.
Oh, so not people choosing to sell.
Exactly. This isn't rational selling. This is margin calls triggering automated market sell orders, which drops the price, which triggers even more margin calls.
A vicious cycle.
But the critical piece of data here is where this liquidation is happening. GTYR is sitting exactly at the bottom of its ascending channel.
Right near its support at 32.65. Resistance is way up at 38.52.
So you have peak capitulation intersecting with peak structural support.
It creates a vacuum.
Exactly. When all the forced selling is flushed out of the system, the sell side of the order book becomes incredibly thin.
There is simply no available supply left at 33.70.
Right. So any institutional buy order that steps in to defend that 32.65 support line is going to face zero resistance on the way back up.
Wow. And we are seeing an identical, though maybe slightly less extreme, setup with Lucky Cement, LUCK.
Yes, LUCK is an interesting one.
Price is at 443.00, sitting in what the report defines as a support test zone. Its immediate support is right below it at 438.24, and its RSI is heavily oversold at 11.02.
The mechanics are exactly the same. When price compresses tightly against a support level with an RSI below 20, the risks-to-reward ratio skews heavily in favor of the buyers.
Because the stop-loss placement is obvious.
Exactly. Just below 438, meaning the downside risk is defined and minimal.
While the upside void left by the aggressive selling allows for a rapid mean reversion back toward resistance at 449.89.
Right.
So the overarching theme at the extremes, whether it's PSO running hot at 81 or GTYR freezing at 2.70, is that momentum indicators are showing us where the rubber band is stretched to its absolute breaking point.
They're the warning signs of an impending snapback.
But the vast majority of the KSE-100 doesn't live at the extremes. Let's move into the middle ground, where the RSI sits in that neutral 30 to 70 range.
The neutral zone can be tricky.
Definitely. We have PTC at 72.01 with a neutral stochastic RSI of 37.11. The report places it in an accumulation zone, consolidating above its 70.41 support.
With resistance up at 75.35.
Right. But if the RSI is neutral and the price is just drifting sideways, what exactly makes this accumulation rather than just, dead money?
True institutional accumulation is designed to be invisible.
Invisible how?
Well, if a large fund needs to build a massive position in PTC, they cannot submit a single market order.
Oh, because it would spike the price.
Exactly. You would blow out the order book and send the RSI immediately into overbought territory, totally ruining their average entry price.
So they use algorithmic execution, like time-weighted or volume-weighted average price algorithms.
Exactly right. They slice the order into thousands of microtransactions over days or weeks.
Whoa.
They place passive limit orders just above the 70.41 support line. Every time retail traders sell, the algorithms absorb the shares.
This keeps the price floating in a tight range and keeps the momentum indicators, like the stochastic RSI, dead neutral.
Yep. The footprint of accumulation is a flat price and a flat RSI, combined with heavy defense of a specific support level.
That is fascinating. Okay, that makes sense for PTC. But let's look at Maple Leaf Cement Factory, MLCF.
Okay.
Price is 101.90. Its RSI is also sitting neutral at the lower end at 24.59. But the report doesn't classify this as accumulation.
No, it doesn't.
It has MLCF categorized in a wait zone. It's hovering just above its 100.55 support because it failed to hold the upper half of its channel.
With resistance sitting at 103.96.
Right. So how do we differentiate between an institution quietly accumulating at support and a stock just bleeding out and waiting to crash through the floor?
The difference lies entirely in the preceding price action.
Okay, break that down.
While PTC has been building higher lows, it is maintaining upward structural integrity.
And MLCF.
MLCF, on the other hand, made an attempt to push toward its 108.39 resistance, completely failed, and was aggressively rejected back down to the 100 level.
It's like the difference between packing your bags for a trip, which is accumulation,
Right.
versus sitting at a bus stop wondering if the bus is ever going to show up. That's the wait zone.
That is a perfect analogy. The neutral RSI on MLCF isn't hiding a buyer. It's just showing that the downward momentum has temporarily paused at support.
The order book is in a stalemate.
Exactly. The wait zone designation means the probability of the 100.55 support holding is currently 50-50.
Just a coin toss.
Yeah. If institutional bids aren't sitting at that level to absorb the selling pressure, the moment that line breaks, the algorithmic stop losses will trigger, and that neutral RSI will drop straight to zero.
So you wait because the market hasn't shown its hand yet.
Precisely.
Which brings us to DGKC. Price is 213.80. RSI is dead neutral at 39.99.
Okay, let's look at this one.
It is in a consolidation zone, but the positioning here is just bizarre. It is testing its 215.47 resistance level while simultaneously sitting at the bottom boundary of its ascending channel.
It seems contradictory, right?
Yeah. You can't be at the ceiling and the floor at the same time. What is actually happening in the order flow here?
We are looking at a polarity flip in real time.
A polarity flip.
Yeah. Historical resistance levels frequently turn into new support levels once they are breached. DGKC is currently straddling that exact pivot point.
So 215.47 was the ceiling. It broke through, and now it's coming back down to see if that old ceiling can act as the new floor for its next move upward.
Exactly. And the neutral 39.99 RSI indicates that the retest is happening under highly controlled conditions.
Meaning there is no panic selling driving the price down to retest the level.
Right. It is a slow, methodical bleed to test if the buyers who pushed it above 215 are willing to defend their territory at 208.24.
And if they step in, that level is confirmed as new structural support.
And if it breaks, the secondary resistance at 222.41 becomes irrelevant.
Fascinating. Okay, we have mapped the macro absorption, we've analyzed the mechanics of the overbought and oversold extremes, and we've decoded the hidden order flow in the neutral zone.
Now for the fun stuff.
Yes. Now we move to the anomalies. The wild cards doing something that actively defies standard technical modeling.
These are always interesting to dissect.
Let's look at CNRG. Price is 15.05. It's trending aggressively upward toward its 16.47 resistance, firmly in a bullish zone, yet its RSI is completely subdued at 29.63.
Which is very counterintuitive.
Extremely. When an asset makes a sustained, aggressive move upward, you expect the momentum indicators to heat up. The RSI should be tracking into the 60s or 70s.
Right. The fact that CNERGY is claiming significant ground above its 13.46 support, while the stochastic RSI remains below 30, is highly unusual.
I'm trying to work out the math on that. The only way the price trends upward while the RSI stays cold is if the price action is incredibly compressed.
Compressed.
Yeah, meaning it's not experiencing any sharp vertical spikes that trigger the momentum calculation.
Exactly. It's grinding. It is making higher highs and higher lows, but doing it through a very slow, methodical execution.
Why does that happen?
This usually happens when a stock is flying under the radar of retail momentum traders.
Oh, so it's institutional again.
Yes. The algorithms are steadily lifting the offer, taking available liquidity at a pace that deliberately avoids triggering any volatility sensors.
So it's basically a completely silent rally.
That's a great way to put it.
But if CNRG is the silent rally, TPL properties, TPLP, is an outright mathematical paradox.
Let's hear it.
Price is 15.58. The report places it on breakout watch because it has officially breached its 15.49 resistance line.
Which is a very bullish signal.
It is making new highs for its local structure. Yet the stochastic RSI is sitting at 13.30.
In deep oversold territory.
Right. It is physically breaking out to the upside, but mathematically looks like it's been entirely sold off. How can a stock be successfully pushing upward while looking like it's exhausted?
It's a perfect example of how the look-back period of the stochastic calculation can create a lag effect during sudden trend reversals.
Okay, walk us through the specific timeline of that calculation, because on paper, a breakout with an RSI of 13 looks like a completely broken formula.
Sure. Let's assume the stochastic RSI is set to a standard 14-period look-back on the 4-hour chart.
Okay, 14 periods.
For periods 1 through 13, TPLP experienced a brutal, relentless sell-off. The price kept dropping toward its 13.69 and 11.04 support levels, closing near its lows every single 4-hour session.
Okay, so that dragged the standard RSI down significantly.
Exactly, and consequently, the stochastic RSI pinned itself near zero.
So the mathematical anchor is set heavily to the downside.
Precisely. Then, in period 14, an immense block of buy orders hits the market.
Out of nowhere.
Right. The price surges vertically, blasting straight through the 15.49 resistance line in a single 4-hour window.
Wow, so the current price action is incredibly bullish.
It is. But because the formula is still factoring in the extreme lows from the previous 13 periods, the resulting stochastic value barely twitches.
Ah, because the denominator of the formula is still overwhelmed by the historical selling volume.
Exactly.
So what happens in period 15 and 16, assuming the price stays above that 15.49 breakout line?
This is exactly why it is on breakout watch. As those older, heavily negative periods roll off the back of the 14-period calculation and are replaced by the new, higher closing prices, the math is going to aggressively catch up.
You'll see a slingshot effect.
Yes, the RSI will violently spike from 13 up into the 70s or 80s, even if the price just moves sideways above support.
It is the coil spring effect. The momentum isn't actually exhausted, it just hasn't registered in the trailing data set yet.
It's like an athlete who somehow is winning a sprint but looks completely and utterly exhausted.
Yeah, their momentum is carrying them forward even if the vitals look shot. This is why you cannot trade off a single data point.
It's a recipe for disaster.
If you screened purely for stocks with a low RSI and blindly bought TPLP thinking it was at the bottom of a channel, you'd be buying a stock that just broke resistance.
You have to understand the context of the math.
Absolutely. So, let's pull all of this together for you. We started by diagnosing the overarching KSE-100 index, We saw a surface-level consolidation phase that, upon closer inspection of the volume and order flow, reveals massive institutional supply absorption.
Which is a net positive for the broader market.
It is. But beneath that macro calm, the 4-hour charts expose a really fractured ecosystem.
We have liquidity sweeps happening on breakouts like PSO.
And margin liquidations creating buyer vacuums in GTYR.
Plus complex algorithmic accumulation masking itself in the neutral zones with PTC.
The core utility of the 4-hour time frame is that it strips away the narrative. It shows you the actual mechanics of the order book.
It allows you to see where liquidity is clustered and how momentum is either driving a move or acting as a drag coefficient.
Which is exactly why you have to look past the overall temperature and check the vital signs of the individual components. But before we wrap up, I want to leave you with a final thought to consider, something that kind of challenges our entire framework today.
Oh, this should be good.
We have spent this deep dive treating these technical metrics, the stochastic RSIs, the ascending channels, the precise limit order walls as fundamental laws of market physics.
We rely on them pretty heavily.
We do. We use them to model the probability of future price action. But you have to ask yourself, are technical charts actually a predictive map of human behavior? Or are they simply a flawless, highly detailed history of the recent past?
That is the ultimate question for any trader.
Right. If a sudden, unpriced macroeconomic shock hits the wire tomorrow morning, like a severe liquidity crisis or a massive geopolitical escalation, do these carefully drawn support channels hold any structural weight whatsoever?
History says probably not.
Exactly. Does raw, unfiltered human panic instantly overwrite the algorithms, rendering all of this beautifully calculated math completely obsolete?
It's a sobering thought.
Keep that in mind the next time you see a stock approach an unbreakable support line. Until next time, keep digging into the data.